This next speaker doesn't need any introduction because it's me. I'm Brian Overby, the Senior Options Analyst at Ally Invest here. And I'm going to take the options game to the next level. We just had a great conversation with Shelley Siegler, the Director of Education at Snyder Advisors, and talked a lot about covered call writing. I'm going to take options to the next level. We're going to talk about long call spreads. And I think if you are trading options overall, especially if you like to buy option contracts, we talked a lot about how to use options to enhance a stock portfolio in the last segment. Now, if you're thinking about buying options, I think it is pretty important that you understand and are not afraid to expand your option knowledge and learn a little bit about spreads. So, who's the perfect person to attend this event right now? Well, maybe you've done a little bit of option trading. You actually know what an option contract is. You bought a put or you bought a call. And now it's time to go to the next level and learn about the next type of trading, the next level that you can be approved for inside your Ally Invest trading account is spread trading. So let's jump into it right now. Okay, so now options, when we talk about options in general, it's always important that you get a copy of the characteristics and risks of standardized options. Now, you can get that by going to ally.com/invest/disclosures. So I just like to highlight that whenever I'm going to get into more advanced option trades. Okay, so what is an option? I'm going to spend 2 minutes, maybe even 1 minute on the basics. So an option is a contract. Now, that contract will give the owner the right to buy or sell an asset at a fixed price for a specific period of time. And it obligates the seller to take the opposite side if and when the right embedded in the contract is exercised by the owner. Now, what does this really mean? What is this all about? Whenever you're trading an option, you're trading an actual contract. And there's a lot of terms that are similar to the insurance world, if you will, in that an underwriter writes a contract and then you would buy that contract. So what does that mean? That means that if you buy that contract, you get a right. The person that sells that contract takes on an obligation. So the bottom of our slide here, we see buyers pay cash and they receive that benefit or that right. Buyers pay cash and receive that benefit or that right. Sellers receive cash and they take on an obligation for doing so. And this is where the term calls and puts come from. If I sell a call, that means that you have the right to call stock away from me. If I sell a put, that means that you have the right to put stock to me. And here's the 4 basic trades that we can do with options in general. And we're going to highlight the 2 that we're going to focus on in this PowerPoint today. If you are the buyer of a call, that means you're going to have the right to buy the underlying asset, right? So in our instance, we're only going to talk about stock options today. We're going to make it simple. Options can be traded on a lot of different things, indexes in general, futures contracts, but we're going to focus on stock options. So if I buy a call, I'm considered long that call after I bought it. I will now have a right to buy 100 shares of that underlying stock at that predetermined price. We call that the strike price. The other side of the coin is, well, if I sell an option contract, I take on an obligation. I would be considered short that contract after I sold it, and I'd also be referred to often as the writer of the contract. And I'm going all the way back to those insurance things that we were talking about. Now, what I have highlighted, I have circled here is the right to buy for the call and the obligation to sell on the call option. That's the trade we're going to look at today. That's called a long call spread. Now, obviously, if we went over to the right-hand side under the put, if we did both of those, that would be a long put spread. Now, this is all dependent on what strike prices you're buying and the different expiration date. So let's get into that. I have a fictitious example of a long call spread, just using XYZ stock. We're going to look at a real trade, and I did promise a question earlier in the event. Somebody asked, well, I will, if we have time at the end of the show, talk a little bit about the Ally Invest option trading platform, and I'll highlight a trade or 2 for you, a couple of long call spreads overall. But nothing here is meant to be a recommendation. We're just going to learn here, and that's what this digital conference is all about. All right, so our long call spread, we're bullish, first of all, realize that. If I buy a long call spread, I'm saying I want the market to go up. And to determine that, I need to look at the strike prices that I'm buying. So in this instance, XYZ is a fictitious stock. We have it trading at $63.90. We're going to buy one 45-day. So we're just going to go up 45 days. We're just picking a generic example here. We're going to buy the 60 strike call. So that call is in the money relative to where the stock is at. We are then going to go out of the money and we're going to sell one 45-day 70 strike call. We're paying more for the in the money call and we're receiving less for the out of the money call. So this is done for a net debit of $4.50 to the account. So this is how I've set this entire trade up. We'll look at the profit and loss graph overall, but I can execute this inside the Ally Invest platform all as one trade. And that's what we're going to focus on to start with. Just doing a long call spread as a long call spread. We're not going to buy the option first and then sell it later. We're doing this all as a call, as one spread. We'd say we are going to put this in at a limit price of $4.50. And you'll see that we actually have it in parentheses, meaning that this is a debit to the account. So this would be $450 plus commission. Now, just like if I bought the option outright, the cost would be $6.10 overall. Now, that would be my maximum risk. If I just bought that call option, it would be $610 plus commission for one option contract. We've lowered our risk now. We brought it down to $450. But in the options world, it's always a give and take, right? We have lowered our risk by selling that option, but from 70 on up, our upside is capped. In theory, on a long call, we have unlimited upside. The stock could, in theory, go to infinity, right, over that time period. Most likely it wouldn't, but in theory, that's our upside with a long call. When we're looking at a long call spread, we are reducing our risk now, but we're capping our upside later. Okay, so let's just talk about the max risk and the max loss and the break even, just in short, and then we'll look at a profit and loss graph. Okay, the max risk is going to be the net debit paid, just like if we bought that option contract, we bought an option contract outright, that would be our maximum risk. And in the option trading world and the spread trading, if you pay a debit, usually that's going to be your maximum risk too, and it is in this case. So it's $4.50, or for every one-by-one spread that we did, $450 plus commissions. Break even, or a max profit on this. We look at the width of the spread to determine that. 70 minus 60, if we look at the strike prices, is $10. So the width of the spreads here is $10, 10, I guess I got to use both hands to get to 10, minus the net debit paid, which is $4.50, or our maximum profit potential is $5.50. So our downside risk is $4.50, our upside risk is $5.50. But the most important number that I want to start with, if we do this, stock started at $63.90. We need the stock to get to at least $64.50, which is that strike, the 60 strike call, plus the $4.50 that we paid for it, or $64.50 overall. All right, that's the long call spread. Now, if I'm doing this trade, I need to realize that, yeah, there's a difference between where the stock is at and where the break even is at expiration for this trade. This would mean 45 days from now, this is where our break even would be at. We'd need it to move about 70 cents. Now, if it happens before expiration, that break even will move because there's a time component in the option contract. So let's talk a little bit about that time component, because to me, this is the main reason why you'd want to do a long call spread overall versus buying an option contract outright. All right. So here's the long call spread, and we have a profit and loss table. I'm going to go through this fairly quickly, but we're just going to fast forward to expiration. We're going to look at different prices and what the intrinsic value or the real value of the option contract would be at that expiration date. So we have a 45-day option. We're going to fast forward and notice stock now is at expiration. If the stock goes down to 55, here's the good news and the bad news, right? We lose, if it's at 55, our 60 call, the right to buy stock at 60 does us no good. But also that obligation that we to sell our stock or our option contract via the assignment at 70, well, that's worthless also. So our net loss is that 450. And that's true from 60 on down to 55, on down to 50, down to 30. It doesn't matter. This option would expire worthless, and this one would also. We lose the 450. Now, our break even, like I said, we need it to get to 64.50, which is the debit that we paid, plus that strike price of 60 to get to a net we'd have a net loss on our long option of $1.60, a net gain of our short option of $1.60, and our break even would be 0. All right, now on the upside, from 70 on up, we get capped, right? So at 70 is where our obligation kicks in. Our call option should be worth intrinsic, real value, because we're at expiration. It should be worth at least $3.90. That would be our profit and loss. Well, I'm sure to say our profit on that position would be $3.90. Our loss would be, our gain would also be $1.60, because that option contract would still expire worthless in theory, right, at 70. So $5.50 is our upside, and that's where it's capped. From there on up, that's the way the cookie crumbles. We cannot gain any more than $5.50 on this position on a $4.50 investment overall. Okay, now here's where here's the graph that I'd like to talk about more so. This, I think, explains it. A picture's worth 1,000 words, right? This is a profit and loss graph, and we're fast forwarding to expiration. So if we fast forward to expiration here, we see the x-axis going across here. The x-axis is the stock price at expiration. The y-axis, the up and down axis, is the profit and loss of the entire position of both option contracts. Now, I've taken the time to put in the long stock position here. Long stock, if you just bought 100 shares of stock, now remember, our option contracts each represent 100 shares of stock. You have the right to buy 100 at 60 and the right to sell, or the obligation to sell 100 at 70. So long stock at 63.90, well, this is what our profit and loss graph would look like, right? We'd have substantial upside, basically infinite in theory. On the downside, we have all the downside all the way down to 0. Break even right at 63.90. Okay, now we're going to fast forward to expiration on the options contract, and basically from 70 on up, we have limited and known upside. From 60 on down, notice our strike price, we have limited and known downside. So basically, if it's not between the strike prices, we're just going to take our ball and go home. We're not going to play anymore. But between 60 and 70, we do play. Now, one thing to highlight here, and that I've done on the graph, is that at right here at 63.90 and 64.50, right? These are our break evens. Our break even on the option strategy is just a smidge above the break even on the long stock. And why is that? It's because there's a time component in this. In other words, we are buying more time premium than we are selling. And that's what creates that difference in the break even at expiration on our spread strategy here. Okay, so how can we adjust that? How can we control that? And that's the next slide here. We're going to talk about spread time premium analysis. I know it's a mouthful, and I know don't get too excited out there in the YouTube space, but in general, spread time premium analysis means we're going to look at how much intrinsic value we're buying on our option contract and how much time value we're paying for on the option contract also that we're buying. And then obviously we'll look at the out of the money option contract, and that's all going to be time value, and we're selling that option. So to start with, we know that the stock was at 63.90. The 60 strike call option, pretend this is an option chain, right? The Ally Invest option chain, if you will, is trading for $6.10. We paid $3.90 for it. The total time value, that means, we paid $6.10 for it. The intrinsic value, if you take the strike price, and you subtract the stock from that, you get $3.90. So that's real value. If we exercised our option today, we would have $3.90 worth of value in that option contract. The time here then is $2. The total time premium then is whatever's left, and that's $2.20. We sell this option contract for $160, and we see that in that instance, we have no intrinsic value, right? It's out of the money. The stock is the call price is at 70, and the stock is at 63.90. There's no benefit to exercise that. If you exercise that option contract, you just get the stupid award for doing it, right? You'd be buying stock at 70 when you could buy it on the real market at 63.90, not via the option. So in short, we see that the time premium of this entire spread, we're paying $220. We're receiving 160. Our net time premium is 60 cents to the account. So we're paying that time premium of 60 cents. What was the difference between the break even? Well, we look back at the chart, 63.90, 64.50. It was that 60 cents overall. So that was that spread helped us, as opposed to buying the option outright, helped us manage our risk, helped us lower our break-even point, and gave us less susceptibility to time premium. Okay, so if I'm going to trade spreads, this is a benefit that you get. You can play games with the time premium in your option contract. So let's look at another spread. We're going to look at doing the same underlying stock here, but we're going to buy the 60 call and we're going to sell the 65 call. Remember, before we sold the 70, we made it 10 points wide. This is now only 5 points wide in general. So we're paying that same 610, but the 65 call was trading for 290. The net debit is 320 now. That's why it's in parentheses. That's our max risk, 320. Our max profit is going to be the width of the spread, 5 points, 65 to 60, minus 320 or 180. And our break even will be 63.20 on this. The strike price plus the 320, 63.20 overall. All right. So if we look at the time premium analysis, this is the new spread. That's how I highlighted it on our slides. The time premium analysis here, now it's not a negative number anymore. It's a positive number. Why? Instead of selling 160 worth of time premium, we're selling 290. So now we're actually paying a debit for this trade, but one of the biggest downside of long option traders is their susceptibility to time premium erosion as expiration approaches. Or basic, to say it very layman-like, is time decay. The time decay in the price of that option contract always accelerates as expiration approaches. So now we've actually set up our strategy where we're net positive time. We've sold more time, 290, than we bought, 220. So guess what's going to happen to our break-even line on our x-axis relative to the underlying stock? We're going to actually have a lower break-even of 63.20. I apologize for jumping back on the slides. Versus 63.90 if we bought the stock outright. Why? Because we sold 70 cents more time premium than we bought. Okay, so why am I bringing all this stuff up? Why are we talking about this? If you've been buying options and you've been buying calls, you've been buying puts, in this marketplace, actually, the buyers of options in general have done better than sellers of options. Now, this is an unprecedented time. And why do I say that? I say that because if you're buying options and you've gotten your forecast correct, the markets have been more volatile than what the marketplace has been implying overall. Now, this is just looking at the implied volatility of the option contracts relative to what the actual stock has done. And the stocks, and I think you might agree, have actually been more volatile than less volatile. On the way down, they went down harder and faster. And on the way up, they went up harder and faster than anticipated by the marketplace. So overall, it's been good to be a buyer of option contracts. So if I'm doing this and I'm buying options, what's the next step? Well, it's learning how to manage the hardest component of an option contract, the time premium component. So if we do this and we decide that we want to do this 65 strike, we don't have as much upside. We don't have 10 points in width between the strikes. We only have 5. But we know that if the stock just stays where it's at, we're actually going to make 70 cents on this trade if the stock stays, if the stock stays where it's at or even drifts lower. If we go all the way down to 63.20, where our break even is at, if the stock goes down to 63.30, guess what? I'm profitable on this trade at that expiration date overall. All right. So what does this mean, first of all, in spread trading? So I'm assuming this is our first foray in long spreads. If I'm looking at a long spread trade, here's what I have. We have this trade that we're highlighting is the one where we paid a net debit of 320 to the account. If we look at our profit and loss graph, we're at expiration, which is the Ally Invest plum color that we have here. From 60 on down, the max loss is that 320. From 65 on up, our max gain then on this position is not going to be quite as much as it was on the other side, right? We have a little bit more risk than the reward on the upside, but there's a lot of benefit that comes with it. So $5, the width of the spread minus the 320 that we paid for it, that is going to be $2.80 overall. So that is our max upside. I'm sorry, $1.80, and that'll be our max upside on the trade. And you can see that right here on our graph, $1.80. That's where our max upside is at. Okay, so once again, between the strikes, we play. If the stock goes down below 60, above 65, we'll take our ball and go home. We don't play anymore. Now, I've highlighted on this graph, I've actually taken the time to go on it and look in theory what happens with 20 days remaining, what happens as of today, and what happens at expiration. Remember, we started with a 45-day option contract. So today would be the blue line, day 45. Here's the one downside of doing spreads is that if it reaches your strike and it does it right away and you get no time premium decay, you have one option contract that is saying, I would like the market to go down. And that's the option that we're selling. You have one option contract that says the market wants to go up, and they kind of fight with each other as long as there's time value in that option contract. So it's better if I do this trade if the stock takes a while to get to my high strike, to get to the 65 strike. At day with 20 days remaining, which means 25 days have gone away, I'm a little bit closer. And then in that last 20 days, it's like, wham, I hit my max profit. So this is just something that you should highlight and you should know and be aware of. If I'm trading long spreads, I got to be very particular about the expiration that I'm trading. It means a lot more on my forecasting and when I think the underlying stock might move. Now, if the stock skyrockets from 65 and just skyrockets all the way up to 70 or 80, yeah, all the time premium is going to go away anyways because both option contracts will be really deep in the money overall. All right. So with that said, things to think about when we're looking at options. And then I need to ask you to have some questions now. Go on in and answer, start asking your questions in the chat box. I'll try to address them if I can. I'm on my own here, so if you can start typing them up, we'll get them up and running, and I'll be able to look at them, and I'll see if I can address some of your questions. But I think I'm going to cover a lot of them right here. This is my favorite slide, things to think about. Now, I'm going to highlight here, the moral to the story is long spreads to outright buying. We're comparing that. These are things to think about. If you're thinking about outright buying an option, and an alternative could be a long spread. So here's some of the things. Long spreads usually have longer overall time, have lower overall time decay, lower overall exposure to time decay. And we showed you that you can even set it up as a positive time decay strategy. If you choose your strikes right, you can set this up so that time is your friend when you're doing an option strategy. That also means there's less susceptibility to implied volatility. Now, we haven't talked in detail about implied volatility, but that's also a component of an options price. And if we know earnings are coming, there's a known noon event that can increase implied volatility and can affect any of your option strategies, especially if you're just buying them outright. So since we can control the amount of time value, implied volatility can only mess with time value. All right. More commissions with long spreads. There are still commissions in the option trading world, but they are coming down precipitously, without a doubt. But you do have two bid-ask spreads, two bid and ask spreads to deal with on entry. And if you were to close it, you would also have it on exit. So commissions are always something you should think about inside your strategy. Obviously, you have limited and known upside versus unlimited if you buy it outright. We touched on that a lot. What would like the move to happen closer to expiration versus right away? Now, I'd get an F in English for writing it that way, but I guess I did that anyways. Good thing I have a degree in math, right? Would like the move to happen closer to expiration date than right away. That is true. And we highlighted that on our last graphic. If I'm doing the option, if I'm doing a long spread, I can always, let's put it this way. If I'm buying a long option contract, it's not going to really hurt me to go too far out in time. So I want to err on the side of buying too much time in general. The only downside is it adds the cost. Time is money. But that gives me more time to be right on my forecast. All right. On spreads, that's not really the case because I want to be right on my forecast closer to that expiration date. So choosing your expiration is very important in the spread trading world. And it really depends on the underlying stock. If it's a more volatile stock, I'll be shorter. First of all, you'll get more time premium. In other words, I maybe look at a couple of weeks out. As opposed to a less volatile stock, I might be more willing to go out 4 weeks in time or maybe 5 weeks. But it depends a lot on the volatility of the underlying stock overall. Okay. Now, two last ones that are fairly important, then I'll get to your questions. Early assignment of the short strike. Can you be assigned early on one call out on one of the options and not on the other? Well, if you're going to be assigned, that implies that you sold it. And that is possible, but in the options trading world on the call side, it doesn't happen as often. But you got to realize that if somebody exercises a call option, that means they're paying cash now as opposed to paying cash at the expiration date. Most people would rather pay it later at the expiration date, but they're humans. They can exercise early and they have that right to do it. What if the stock ends up between the strikes at expiration? Now, this is a situation that you got to be aware of. If I buy a long spread, and in our instance, the stock was between 60 and 65. That was the last spread that we looked at. We bought a 60, we sold a 65. If it's at 63, you're going to want to do something with that trade. Don't want to fall asleep on expiration. You probably want to close out that trade. And that means you're selling to close your long option, you're buying to close your short option contract, or if you plan on owning the stock, right? The stock's not going to get called. You're not going to buy it and sell it via the option contracts because it's between the strikes. So what can I do if that's that situation? I can go on out and if I want to, I can let the long option be exercised, but I got to make sure I got the capital to pay for it, right? I got to be able to buy that underlying stock. So just be aware that if the stock finishes between the strikes, you have to do something. All right. Well, I'm getting a little bit long here. We're about to the end of our digital conference overall, but I want to answer some of your questions. So 1 second here, I'm riding solo. Let me log into my computer and look at the questions that are up. And I want to say, what a great event today. This has just been a lot of fun participating in. And if I look at this, we have quite a few that are out here. All right, overall. Scroll down, okay. Thanks for being patient with me. Now, this is all my information. Like I said, I'm known as the options guy at Ally Invest. You can email me any of these questions that I can't get to today. You can email them to me at theoptionsguy@invest.ally.com. Follow me on Twitter. My handle is Brian Overby. And here's a little book that I wrote called The Options Playbook. You can go to optionsplaybook.com and check it out. We also sell it on Amazon overall. So please do check out The Options Playbook. Okay, at optionsplaybook.com. All right, Mike Morrow. Mike is saying, I'm always a little confused by these spreads. Do you need to exercise the call at some point if it goes above the strike, and how do you do that? I'm referencing the long call spread you're talking about. Well, you can. I mean, you would have to call the desk to exercise and say, I want to exercise and I want to buy the stock. But what's most common? The most common thing to do when you're doing spread trading is to buy to open the option contracts. And then when it reaches a price that you're comfortable with or uncomfortable with on the downside, if you will, then you sell to close those positions. So what does the order look like after you have the position on? You bought to open the call, so you want to sell to close the call, and you've sold to open the second call. That means you're buying to close the second call. So it's buy to close and sell to close when you're closing out that option contract strategy. So that is the more common thing to do. And if you have a position on like this, you need to be aware of the markets, and especially on that expiration date, where that underlying stock is at relative to the strike prices. All right. If you sell, okay, so this is Bberg. If you sell a covered call on an option at 63.90, you need to have 6,390 in cash in your account, right? Okay. If you sell a call on an option at 63.90, now I'm going to use our example, Bberg, in that we bought the 60 strike call and we sold the 65 strike call. We are considered covered on that position because we have the right to buy the stock at 60 and we have the obligation to sell the stock at 65. So because we have the right to buy at a lower price than we're selling at, we do not have to have the capital in the account to buy that underlying stock at that strike price, right? So we're buying, we have a right to buy at a lower price and we have the right to sell at a higher price. Okay, now, if we get to expiration, I guess I'll go in more detail, but if we get to that expiration date, and at that expiration, let's say that the last scenario that I painted is happening. The stock is at 63 and I have the 60 strike call and I've sold the 65. So the stock is in limbo. It's between the two strike prices. If you do not have the capital in your account to buy the 100 shares of stock, well, in that situation, your brokerage firm may close out your position for you. They may close you out because if you were to exercise, you would end up with 100 shares of stock. You got to pay for that 100 shares. Okay. So I'm going to emphasize this, things to think about. If you're doing option trading and you're doing spreads, you want to be awake one day of the month, and that's that expiration day. And you want to adjust your position or trade out of it or do something with it overall. All right. Here's another one. In the last presentation, you were using monthly expirations. Is that still the case here, or can you use this strategy with weekly options? I'm going to look at another one. What happens if you allow the option to expire? I just addressed that. When do you want to take a profit, or do you sell both options or wait until expiration? Okay, when do you want to take a profit? Well, we did talk about this in the last show, and expirations came up. I kind of emphasized if I'm doing long spreads, picking my expiration is more important than the expiration I'm choosing when I'm buying options outright. In that we max out closer to that expiration date. So you got to choose the expiration wisely, and there's no golden book of answers. It really depends more upon the volatility of the underlying and your forecast for that underlying. So I don't have a great answer for that because we'd have to look at a specific example overall. And then here, they're using monthly. Can you use the strategy with weekly options? Yeah, you can. And in some instances, because of the way that the pricing of the option contract as expiration approaches, that can be done. So weekly options are a viable expiration in a long call spread. All right, so now I'm getting more. I think I got a few more. I got 10 more minutes here. I might come back to a few more questions. Let me see what else we have on these questions. But I'm going to look at the platform because I'm getting a lot of questions just about the platform in general and about entering a trade. So I'm going to pull, at this point in time, I'm going to pull over the Ally Invest option trading platform. And I have a little known stock up here. It's actually called Walmart. Walmart looks like it's down today. This was a live quote. The markets are closed at this time. It's 4:20 Eastern time right now. And we see that the market is 120.30, down 77 cents. We have Walmart stock. Here's how I would approach just looking at it. Now, this is not meant to be a recommendation by any means, but I'm going to look at more than one trade. And I'm going to show you how you would enter that trade on the Ally Invest trading platform, okay? Specifically with spreads. I personally think that we are one of the easiest platforms to actually enter a spread trade on. First of all, if we look across the top, we're showing you the real-time stock price. We're showing you if they are going to announce earnings, and we're also showing you the dividend, the next dividend date and when it's going to be paid. We have all the different expirations you can choose from. You can just check a box. Right now, we're going to look at the July 17th expiration. It's 23 days away. Why am I picking that? Well, it's the monthly expiration. It's the third Friday of the month. You could look at the 16-day, the 8-day. It all depends on your forecast, everything that I talked about on this event. Now, if I go and I look at this overall, here's what we have. Stock's at 120. I am going to, and part of the reason why I picked Walmart, I didn't pick Walmart because I like Walmart. I picked Walmart because it's trading very close to the actual strike prices, and it has 1 point strike. Because now I can show you how we can adjust these strikes to try to think about how it affects our time premium. Okay, so let's go 2 points in the money down to the 118 strike, and let's go 2 points out of the money to the 122 strike. Now, the quote is down below on the screen. I'm going to have to scroll down to look at that quote. But I've traded options enough to know that if I pick these strikes and I'm 4 points wide, I'm 2 points in and 2 points out, this should be trading for about $2. Might not be exactly $2, but it should be trading for about $2. Why? Because if I go equidistant in and out of the money, I should be buying about the same amount of time premium as I'm selling overall. So if we scroll down and we look at it, we're $2.26. Now we're a little bit in the money, right? Because we're trading at 120.30. But this is the concept. This is the thought. If this was right at 120, right? We got 30 cents a little bit in the money here. If this was right at 120, this would be a trading for exactly $2 or approximately. I mean, you're still in the real world. This is the theory that I'm talking about. And that's how you can kind of look at how can I center and manage my risk and manage my time premium exposure. So now we have a 4 point wide trade. The maximum is 4 points. The net debit is $2.26 in this instance. That means $226 if we filled at the midpoint, right? If we filled at the midpoint, which is right between the bid and ask, and that's the net midpoint. We would click this button over here, and my screen's blowing up a little bit, but this is where the trade would populate. We click it like this, say we want to pay a net debit. If we want to try to fill it at the midpoint fills are never guaranteed. We can just click on that, and that would enter the order. And if we wanted to place it, we just hit preview order. So a very simple process to look at entering that trade. Now, let's talk a little bit more about these spreads. Okay, we looked at it. We got $2, 4 points wide. We got $2. If I wanted to make it cheaper, if I want to lower that cost, okay, we're going to keep the theme of the 4 point wide spread. But if I want to lower that cost, what I'm going to have to do is I'm going to have to sell a more out of the money option contract. So I go up one strike and I buy the 119. Now I'm going to sell the 123. And that will lower the cost of my spread. Now that is trading for exactly $2 in this instance. And I've lowered that cost by doing it. But now I need the stock to go up higher to reach that strike. And now I am definitely paying more time premium than I'm selling. So at this point in time, if I do this, my break even now goes to 119 plus $2, which is the midpoint here, or 121, right? So I need the stock to move up 70 cents to get to the break even point. Now, if I want that break even point to be below where the stock is, I go the opposite direction, right? I would have to go down. We did the 118. Let's go down to the 117, and we make it 4 points, and we sell the 121. All right. So now in this instance, 117 plus 243, right, where the midpoint is at, is 119.43. 117 plus 243 is 119.43. The market is at 120.30. Okay, so now by going down 1 point from our original strike, still keeping the 4 point wide spread, now we don't mind if the stock just stays where it's at or if it goes up in price because we are selling more time premium than we're buying. All right, how fun was that? Now, I'm also going to highlight this over here. We can see this at expiration. We don't have the stock graph on it, but this is the profit and loss calculator, much the same as the calculator that, or much the same as the graphs that I made inside the PowerPoint. We're showing this at expiration. This is our profit and loss graph. And this is our profit and loss graph as of today. The colored line is as of today. Now, we have 22 days remaining. I'm going to take this all the way down and make it basically 1 day remaining to expiration, and I'm going to regraph it. Notice the color line looks very close to the expiration graph. Let's go out even a little further in time. Let's do it like 5 days remaining, and we'll graph it. And now you just see as expiration approaches, our colored line, which is showing our theoretical profit and loss graph as expiration approaches, is slowly being drawn in like gravity towards that expiration profit and loss graph. And at expiration, it will come in together, and it'll basically start trading just like that expiration graph, the dotted line overall. All right, now, can I do this with puts? Yeah, you definitely can. On the options world, if we go over to the other side, we'll just start with the 4-point wide. This would be a long put spread. I'm going to go 2 points in the money. You'll note that that's highlighted. The colors on the platform here's highlighted. We're going to be buying at 122, and we're going to be selling at 118. That would be the 4-point wide spread. We're going 2 points in the money, 2 points out of the money approximately, and that's trading for 182 overall. If I wanted to be bearish, I wanted to use that same expiration, I would just hit trade. And over here, we'd see the preview. Try to fill it at the mid price, click on that, and we're all ready. We're buying to open, notice, the 122 strike put with the July 17th expiration, and we're selling to open, highlight that we're selling it to open, we're not closing, the 118 strike July 17 put. Now, somebody asked about expiration, what might happen? Well, if we were going to close out our position, we'd actually just change this from a sell to open to a buy to close, and from a buy to open to a sell to close. And that means that you'll see that it's quoting for the same quote, basically 182. Markets are closed right now, so that quote won't be moving. But that would be, if we put that position on, we would open it, and now if we wanted to take it off, we would close it. And we can do both of these trades inside the Ally Invest option trading platform at a all as one trade, but we would have to pay a commission for each option contract that we're trading. All right, I got a couple more questions. We're about ready to sign off here from the digital conference. I know my colleague, Lindsey Bell, who did a great job at the beginning half, such a great presentation from her and Kelly, and also was a wonderful hostess today. But let me address a couple more questions. I still see a couple of them that came in, but a lot of the questions were basically around the Ally Invest option trading platform. But let me see what else we have here, okay? All right, Eric, when you take a profit, do you sell both options or do you have to wait till expiration? That was basically the same thing. Can you demo and trade? What happens if you allow the option? Okay, so what happens if you allow both option contracts to expire? That comes from Scott. Scott asking, what happens if you let both option contracts expire? Okay, if the market goes down and that expires, that's a bad thing. That means that you've lost what you invested. And in this instance, that with the one on the screen, if we filled at $1.82, it would be $182 plus commission for every 1-by-1 spread that we did. Now, if you went to expiration and both options got assigned, right, it didn't land in between the strikes, it was up at, well, in this instance, we're bearish now. Let's switch it up and do the call. Let's do the other side. And then I'll look at the profit and loss graph and I'll talk about it, okay? So I'm going to clear this up. And I'm going to buy the 118, sell the 122. All right. If we do this now at expiration, and the stock, this line is actually where the stock is at, and the stock ends up all the way up around 124, and we fall asleep. We don't trade out of this. Nothing happens. Now we're at 124 at expiration. We got our maximum upside that we can make. If that is the case, they will exercise and buy your call, buy your stock, and then they'll turn around and sell it. It'll be one transaction, And here's the good thing. In the options world, if this is the case, you do not have to have that capital in your account to do that trade. All right. They will buy the option via exercise on the lower strike call, and then you'll be obligated to sell that stock at the higher price call. So that's a great question. Thanks, Scott.